In this video, we begin our discussion on Chapter 5, where currently we are developing measures for an economy where thus far we have developed a measure for total output in the form of GDP, a measure for resource utilization in the form of the unemployment rate, as well as having defined a performance goal for an economy in the form of full employment. Now what we seek to do is to develop a measure for overall prices as well as for price changes in an economy, where looking ahead, these measures and our performance goal will be useful to us by allowing us to examine two major areas in macroeconomics, as well as a way to develop a framework to explain outcomes in an economy. But before we can proceed to such larger goals, we must first focus on our current goal and develop our measures for prices, which will entail us measuring inflation, examining inflation effects, and concluding by examining inflation data, where with respect to today's development of measuring inflation, we will accomplish this by considering the price level of an economy, to then develop the GDP deflator, which will then allow us to conclude the day by developing the inflation rate. With this in mind, beginning with some preliminaries, through the circular flow, we observe that the exchange of goods and services is a central aspect of an economy, where in the exchange of goods and services, we can observe total output, which we have measured through GDP, resource utilization, which we measured through the unemployment rate, which allows us to see idle labor resources in an economy, where 1 minus the unemployment rate will also allow us to see the employment rate, which will let us see active labor resources in an economy. And we can also observe prices, in that how much goods and services will typically cost in an economy, where this third thing, that is prices, will be our focus for now in terms of measuring, where with respect to the prices in an economy, we are interested in measuring them given that in a transaction, the buyer uses their income to purchase goods and services, which then becomes income to the seller. Should the prices on goods and services change, then the amount a buyer can purchase will change, as well as how much a seller will receive. This means that buyers and sellers can be made better or worse off depending on price changes. Well, with agents potentially being made worse off, we would like a means of quantifying this problem. So, to measure price changes in an economy then, what we first need to do then is measure overall prices in an economy, given that in an economy we have seen in our development of GDP that there will be more than one good or service to consider, where each of these goods and services will carry their own price point. So we need a way to summarize these prices so that we can say that overall prices in the economy have either increased, decreased, or stayed the same, where the way that we'll achieve this is by considering the price of a basket of goods, where the price of a basket of goods will serve as the price level for our economy, where the price level will formally be defined as the typical cost of goods and services in an economy, where changes in this price level will mean changes in overall prices, such that if there's an increase in the price level, we can imply that there's increases in overall prices in the economy, and this is how we will define inflation. That is, increases in the price level of an economy. Likewise, if there's decreases in the price level, this will imply decreases in overall prices, which is how we will define deflation. That is, decreases in the price level of an economy. Now, with respect to this basket of goods that will be our price level, we can construct it through a couple different ways, where two common approaches are to consider an average basket of goods, such as what the typical consumer in the economy is purchasing. Alternatively, we could consider the basket of all goods and services, in which we'll proceed considering the basket of all goods and services, as this will allow us to build upon what we have seen and know about GDP. So, to continue and consider the basket of all goods and services, let us turn to GDP, which recall considers all goods and services produced domestically in an economy for a given time period. Furthermore, since we're concerned with prices over time, with respect to GDP, this means that we can turn to using nominal GDP as well as real GDP and looking at them at a scaled ratio, given that nominal GDP considers output without prices being controlled for, while real GDP considers total output with respect to prices being controlled for. Therefore, looking at them in terms of a ratio will allow us to create an index to see how prices are moving in that economy, and we can see this price index in the following equation, which we'll define as the GDP deflator equaling the ratio between nominal GDP for a given year divided by real GDP for the same year, all scaled by 100. And what this GDP deflator is it's a price index for all goods and services produced in an economy. And it is the broadest way to examine inflation, since once again, the basket of goods that we're considering is the basket of all goods and services, as opposed to an average basket of goods, such as what the typical consumer in an economy is purchasing. So to gain some familiarity with the GDP deflator, serving as our price level for an economy, let us consider an example in which we will use the economy that we examined in Chapter 3, in which in that example we had an economy that we examined over 3 years that produced houses, crops, and clothing, and we had information on price and quantity for all 3 years. In terms of studying and getting familiar with GDP, we then used year 1 as our base year, and we calculated nominal GDP and real GDP for the 3 years, in which, with respect to nominal GDP in which prices weren't controlled for, we saw that in year 1, nominal GDP was 506,000, year 2, 506,500, and for year 3, 507,250, while with respect to real GDP, for once again year 1 was our base year, we saw that year 1 and year 2 had the same value for real GDP, and that it was 506,000, and for year 3, real GDP was found to be 506,500. So with information from our example economy from Chapter 3 recalled, let us go ahead and use the relevant information of nominal GDP and real GDP for each of the 3 years in order to construct the price level for this economy through the GDP deflator. So in the table below, we have nominal and real GDP for each of our 3 years. And in terms of calculating the GDP deflator, that is our price level, for year 1, this is just going to be nominal GDP divided by real GDP, so 506,000 divided by 506,000, all scaled by 100, giving us a value of 100, where something to keep in mind, with respect to the GDP deflator, in terms of our base year, that index value will always bring back a value of 100, given that when examining nominal and real GDP, recall that for the base year, the two values will be the same as we see in this case. And so when we all scale that back by 100, we'll get back a price index value of 100. Now, proceeding on to year 2, in terms of calculating the GDP deflator, this is going to be the ratio between 506,500 divided by 506,000, all scaled by 100, giving us a value of 100.09, as we see in our table below. Then lastly, for year 3, our GDP deflator value is going to be 507,250, scaled by 506,500, or divided by, and all scaled by 100, which will yield us a value of 100.14, as we see in our table. So through the GDP deflator, we have the price level for this economy, in which we see going from year 1 all the way through year 3, we see that this price level is increasing, where by definition, this would mean that inflation is present. So now that we have a way to measure the price level of an economy, as well as having gone through an example of its construction, we can now consider a measure for price change in an economy, which will be done via the inflation rate, which will allow us to quantify the inflation going on in an economy, as opposed to eyeballing if it is present or not, as we did in the previous slide. And with respect to the inflation rate, this is going to be the percentage change in the price level, and mathematically, this is going to be calculated as the price level in a new year minus the price level of an old year, all divided by the price level of the old year, all scaled by 100. So to gain some familiarity with this measure of the inflation rate, let us continue with our example from before, in which we have our GDP deflator value for year 1, 2, and 3 for this economy, and now we would like to construct the inflation rate. Well, with respect to year 1, since we need 2 years worth of information for year 1, the inflation rate is not going to be available. Going from year 1 to year 2, though, we can calculate the inflation rate, in which our new year is going to be year 2, our old year is going to be year 1. So in terms of our inflation rate, this is going to be the difference between 100.09 and 100, all divided by our old year of 100, scaled by 100, giving us a value of 0.09, where with respect to year 3 then, in terms of calculating our inflation rate, this is going from year 2 to year 3, so year 3 is going to be our new year, year 2 is going to be our old year, so this is going to be the difference between 100.14 and 100.09, all divided by our old year value of 100.09, and then when scaled by 100, this will give us a value of 0.04, where in terms of the inflation rate then, this means for year 1, it's not available since we needed 2 years worth of information. In year 2, the inflation rate is 0.09%, and for year 3, it is 0.04%. So as we mentioned in the prior slide when we were just looking at increases in the price level, we saw that inflation was present, and through the inflation rate, we were able to quantify it and conclude that going from year 1 to year 2, the inflation rate is 0.09%, and going from year 2 to year 3, it is 0.04%. And we can now make a further statement though too, is that the inflation rate going from year 2 to year 3, although there is inflation present, we see that the inflation rate has decreased by 0.05 percentage points. So with some familiarity in terms of the price level of an economy through the GDP deflator by going through an example, as well as developing a measure for price changes through the inflation rate, where we will pick up next time is we will turn back and examine how inflation can alter how well off agents are in an economy.